Good morning, and thank you for joining us. We'll get started in just a moment. All right. Hello, and thank you for joining us for today's webinar on 2025 tax preparation strategies. Those of you who may not be familiar with Source Advisors, we have helped CPA firms and their clients maximize specialized federal and state tax incentives for more than 4 decades. We are headquartered in Fort Worth, Texas, where we collaborate with accounting firms throughout the country to bring R&D tax credit, cost segregation, LIFO, 179D, 45L, state and local tax, as well as property tax solutions to their clients. Just a few housekeeping items before I introduce our presenters today. There will be 4 polling questions throughout the presentation. You will need to answer at least 3 of the polling questions and attend at least 50 minutes of the session as measured by the presentation software to qualify for CPE. CPE certificates will be emailed to you within the next 3 business days. Please utilize both the chat and Q&A functionality, which are located in the upper right-hand corner throughout the presentation. However, if you have a specific question for the speakers, please make certain to use the Q&A function so that we may answer them at the end of the presentation, with which there should be sufficient time. If not, we will make certain to catch up with you afterwards. Additionally, you can now download today's presentation using the handout icon also found in the upper right-hand corner. With that, I'm happy to introduce our speakers today. First is Greg Bryan. Greg is Senior Managing Director at Source Advisors, where he is responsible for key client relationships and strategic initiatives for the firm. Combining experience in development, construction, and engineering for more than 4 decades, Greg has a broad understanding of the commercial real estate industry, ranging from project conceptualization through construction and asset management. Greg is a certified member and first president of the American Society of Cost Segregation Professionals, a nonprofit professional organization where he has served as member of the Technical Standards Committee and Testing Committee. He is currently, serves as on the board of directors. After Greg will be Imran Syed. Imran joined Source Advisors in 2010 and is currently the Managing Director of Energy Services. Imran is a mechanical engineer by trade and has more than 15 years of experience in sustainability and energy efficient buildings and is a registered professional engineer. He is also a certified energy manager, a HERS rater, Energy Star partner, and an NAB CEF PV associate. Lastly, we have Chris Vignon. Chris is Managing Director of Indirect Tax, and he's an acclaimed state and local tax specialist and thought leader. Chris is well known for his success in identifying multi-million-dollar tax savings opportunities for Fortune 1000 companies and implementing operational changes for long-term business efficiency. Chris's industry specialties include retail, telecommunications, bankruptcy, and turnarounds. He is a frequent lecturer at business and academic forums and an active member of industry trade associations such as AI, CPA, and TEI. With that, Greg, I will hand it to you.
Great. Thank you so much. So we're going to cover just a few things today. We're going to be talking about the phase down of bonus depreciation, definitions and application of qualified improvement property treatment, as well as Section 179 expensing. And then we're going to talk about the interplay between the tangible property regulations and their impact on cost segregation and strategies you should be considering as you begin to start preparing tax returns for your real estate clients. Bonus depreciation essentially allows you to accelerate the depreciation on certain assets, and the remaining assets will then be treated based on the maker's recovery rules. Bonus depreciation is required. It's not an election. However, you are allowed to elect out on a class-by-class basis. Qualified property eligible for bonus depreciation includes all assets that fall under the maker's recovery treatment that have a tax life of 20 years or less. It can include new property. It can also include used property if certain acquisition requirements are met. And that really relates to the Tax Cut and Jobs Act of 2017, where there are some monumental changes that related to bonus depreciation. Prior to TCJA, you were only able to get bonus depreciation on new construction. This particular slide gives you a little bit of a historical perspective in terms of the rates of bonus depreciation prior to TCJA, as well as the rates that were included in TCJA, and it's color-coded to give you a little bit of perspective in terms of the different nuances. We also had, prior to TCJA, qualified retail, qualified restaurant, and qualified leasehold improvements, as well as QIP that came up in 2016. And going forward, if you look at what happened since 9/28/2017, we saw that there was some really advantageous rates of bonus where we had a 5-year period of 100% bonus on anything that had a maker's recovery period of 20 years or less. We started to encounter a phase down starting in 2023. And then currently, unless there's any legislative changes, we are looking at 40% on eligible assets for 2025, and it will eventually phase down at 2027 to 0. And we'll launch a polling question, please.
All set. What will the rate of bonus depreciation be for 2025? 60%, 40%, 80%, or 100%?
And there's certainly a lot of talk on the street right now in terms of what's going to happen with the new administration. We have a lot of clients asking us what our thoughts are, and it's just hard to tell. I think there's probably a strong likelihood that we could see 100% bonus this year. I think the bigger question is, if it is instituted, will it in fact be retroactive? So it's anybody's guess at this point.
Let's give it just a few more seconds, Greg.
Of course. Yeah, we want to make sure that everybody answers the questions.
Okay, I think we're good to move on.
Okay, great. And of course, the rate of bonus for this year is 40%. Qualified improvement property. So generally, the definition of QIP is new interior improvements placed in service after the initial building was placed in service by the current taxpayer. It only applies to commercial property. So for those folks who have residential rental property, unfortunately, QIP is not in play here. The definitions make further reference to the fact that it cannot be an elevator or an escalator, nor can it be the interior structural framework of the building. And I'll talk a little bit about some nuances on that as it relates to mezzanines in a later slide. Following RevProc 2013-24, you'll be able to file IRS 3115 to implement the QIP. You can see what the rates of bonus are for the QIP and also its eligibility for Section 179 expensing based on certain taxpayers, as well as their thresholds for 179 expensing. So a couple of interpretations and application based on facts and circumstances as it relates to QIP and 179. This particular slide gives you an overview of qualified restaurant, qualified retail, which no longer exists, qualified leasehold, which no longer exists, as well as kind of the all-encompassing qualified improvement property designation. If you are doing look-back studies prior to 2017 and you had qualified improvement assets in there, it's important to understand the 3-year rule that relates to the interior improvements. But other than that, it's been simplified quite a bit going forward from 2017 on. But this is just a good quick reference guide if you are in fact looking at properties that were placed in service many years ago. We see an awful lot of errors occur when tax preparers are looking at capital improvements done to a commercial building. And the assumption is that if it's a tenant improvement, all of it is QIP 15-year, you're done. It could not be further from the truth. So we definitely need to be looking at what elements are going to be eligible for 15-year treatment. But the expectation on the part of Treasury is that embedded within that capital improvement, let's say we're doing a build out for a retail tenant, and it is generally mostly interior improvements, but we're doing installations of storefronts, exterior windows. Maybe we're painting an exterior part of the building, and we might be putting a new air conditioning unit on the roof. Not all of that is going to be QIP. Again, the improvements need to be interior in nature. So if we're looking at the exterior windows and storefronts, those would be 39-year. Also, the assumption is that you are going to be making the effort to identify the 5-year assets. So embedded within those improvements, you might have certain flooring, non-structural millwork, such as decorative millwork, that type of thing, specialty electrical. The expectation is on the part of Treasury that you're going to carve out those items that are eligible for Section 1245 treatment. And if you don't, upon audit, the IRS may treat your recapture as if you had done so. I did mention that elevators and escalators are excluded from the TPR, excuse me, from the QIP definition. However, if we're looking at an addition of a mezzanine to increase internal floor space, it can in fact be QIP. Even though a mezzanine is structural in nature, it is not being used to support the building shell, the building structure. So you have the ability to take that as QIP. We often see this in mini storage facilities where individuals are looking at older retail facilities and installing a mezzanine to an existing Kmart or something like that. And in most cases, that mezzanine can be treated as 15-year QIP. Unfortunately, modifications to enhance the structural integrity of your building to conform with either building code or earthquake-related improvements may not be QIP. Now, why is QIP important to consider? Certainly, there are tax advantageous aspects to this, but we also have some states that decouple from bonus and or QIP. So it's important to understand the nuances on a state-by-state basis. This is a quick slide that gives you an overview of the Section 179 rules and application. I'm not going to go too much in it for the sake of time here, but it gives you a good idea in terms of some of the things that might be eligible for 179 expensing subject to the annual rules and limitations. Close consideration should be given to the bottom 5 categories when we're looking at QIP, some roofs, HVAC, fire protection, and alarm systems and security systems. And of course, there are certain elements within the Section 1245 property, such as portable air conditioning units and other appliances that can in fact be expensed. So let's jump into the tangible property regulations. From a historical perspective, the TPRs were proposed and commentary was given, and then they were finalized in 2014. And for those of us that have been in the industry long enough, it was really a welcome change because it gave us finally some definitive guidance in terms of how to treat income and capital expenditures. And so we looked at how to treat repairs, dispositions, and also certain safe harbors, such as the routine maintenance safe harbor. The PATH Act kind of consolidated some of the information and guidance with respect to qualified improvement property. TCJA eliminated the various qualified leasehold, restaurant, and retail, but there was a glitch, commonly referred to as a retail glitch, where the new QIP was not eligible for bonus. And that was fixed in 2020 with the CARES Act. So that's kind of a quick evolution. Now, what happened when the regs came out is an awful lot of tax professionals rushed towards adopting the regulations by filing IRS Form 3115. That was to adopt the regs. The expectation on the part of Treasury was that we were going to do an analysis between repair to capital or repair or capital to repair and make that corresponding 481A adjustment. So everybody should have adopted the regulations, but are we doing a good job taking a look at what has happened on those properties since the regs were adopted? And we found that a lot of CPAs, just because they don't necessarily have the resources to do so, are entering items, particularly large ticket items, just as 39 year or 27 and a half. And there's an opportunity here to kind of take a look back and determine whether or not those big ticket items can in fact be reclassified. This is an important slide with respect to TPR decision trees. During the current year acquisition of an asset, we don't have as many strategies available to us with respect to the TPRs. We only have the de minimis safe harbor available to you. However, when you've owned the property for more than a year, you have an array of opportunities to offer value to your clients. You certainly can expense items based on the de minimis safe harbor provisions, the thresholds being $2,500 for small taxpayers, $5,000 for large applicable financial statement taxpayers. But also, we have safe harbors which relate to routine maintenance safe harbor, repair and maintenance, and most importantly, or equally importantly, the partial asset disposition. So this is a deduction that you can take when you permanently take an asset out of service. So imagine you just purchased a building 3 years ago, commercial building, and you remove some air conditioning units and you have to capitalize the incoming ones based on a test, which we'll talk about on the next slide. You have the ability to basically write down the remaining tax basis of the assets being taken out of service. It's the only strategy we'll talk about that cannot be done on a retroactive basis. So make sure that if you have clients who are taking major assets out of service this year, that you identify those assets and come up with the correct amount for the PAD. Generally speaking, the TPRs provided us guidance on materials and supplies, de minimis safe harbors, other safe harbors, repairs, and GAA elections and dispositions. And again, it's a very welcome change for those of us who have been in the business long enough. It provided us a lot of guidance. So this is how we analyze an incoming asset. They introduced a new concept called unit of property. So the building itself is unit of property, but for the purposes of determining whether or not an incoming asset can be expensed or capitalized, we have to go through a series of tests. So the first question is, are you adapting the building to a different use, or are you changing a residential property into a commercial, or vice versa? If the answer is no, then you go to the next series of questions. If the answer is yes, you have to capitalize that incoming asset. So let's use the example of an air conditioning unit. So we're looking at a building that's a commercial building. It continues to be a commercial building. So then we go to the next series of decisions, which is it a betterment? So is that air conditioning unit providing material quality or capacity or productivity, or are we ameliorating it to a different state or an expansion? If the answer is no, then your next step is going to the restoration rules, and there's 6 questions within the restoration rules. And if you can say no to all those questions, then you have the ability to expense it. A good example of restoration, I use this a lot, is a roof. If you are looking at a re-roof situation and the contract simply states that you're tearing off a membrane and replacing it for a new membrane with a new membrane, chances are you can expense that roof regardless of the value of that contract. However, if the contract states that you are pulling off the membrane, you are replacing the insulation, you're taking care of gaping holes in the metal deck, you're really triggering the restoration rules. And in that particular case, that contract needs to be capitalized. This is a quick reference that gives you an overview of the various units of property and the sub components that constitute the units of property. I'm not going to go into all of them, but if you're looking at plumbing, analyzing plumbing, we're looking at the bathtubs, pumps, sinks, toilets, etc. So there are some guidance in the regulations that relate to materiality thresholds. So generally speaking, if you're replacing 30% or less of a particular unit of property and you're not triggering the restoration rules, chances are you can expense those incoming assets. So here's an example. We have a single building with 10 existing air handling units on the roof. 6 were replaced in a single year. As a result, you cannot take that as a repair because you've exceeded that materiality threshold for the unit of property. Conversely, If you only replace 4 out of 10, you're right at the cusp, but you can expense those incoming assets. Now, it's important to note that you can't aggregate your numbers. So if you're working on a property that has multiple buildings or a garden style apartment complex, it's a building by building test. So under this scenario, the smaller building gets replaced two out of 2. So you have to capitalize. Building 2, you're replacing 2 out of 10, you can expense. And I apologize for going so quickly because I also have my coworkers' presentations coming right up. So why discuss the TPRs? Well, it has to do with taxes, right? Not all states allow bonus. They decouple from bonus and or 179. So there's a great opportunity here to offer significant value to your clients. The name of the game as it relates to TPRs is expense. We really want to drive towards expensing as many things as possible because it is never subject to recapture upon sale. And I mentioned before that most 3115s were filed back in 2014. So there's a great opportunity to revisit the depreciation schedules and the fixed asset schedules that your clients have for a potential look back study. So the impact on cost segregation can be pretty significant. Excuse me, we're still looking at Section 1245 and Section 1250 property, but we also want to identify qualified improvement property and then items that are going to be eligible as qualified real property for expense treatment. And a well-established study can give you a lot of detail as it relates to the 27.5 and 39-year property, so that 5 years down the road, you can go back to our report and identify specific items that are taken out of service so that you can do the partial asset disposition calculations. Fun fact, auto dealership, just how dramatic this can be. We've got a property that was placed in service in 2000, and only 3% got classified as 39-year. We had a significant amount that was qualified real property. We had land improvements to the tune of $100,000 eligible for bonus, $450,000 of QIP, $360,000 of 5-year, $70,000 dispositions, and $85,000 that were eligible for expense treatment in the same year. So you can see the additional benefit that goes above and beyond a standard cost segregation study. So if you have clients who are subjected to mandating reimaging, whether they be in the limited service hotel, lodging industry, franchise industry, car dealerships, these are great clients to talk to the TPRs about. Okay, and let's launch a polling question.
All right. In what year did the TPRs become final? 2007, 2014, 2002, or 2024? Just need a few more to come in. And I think we should be good.
Okay, great. So action items, take a look at your client's capitalization policies, review the nature of past and current capitalized improvements, conduct a fixed asset or TPR study, identify mechanisms to identify the partial asset disposition. Remember, this is a use it or lose it scenario. Everything else I've talked about can be done on a look back basis. File IRS Form 3115 if required. And don't forget to ask the clients about what's on the horizon for 2025 capital expenditures, because there may be a great strategy to deploy to help them maximize benefits related to their capital improvements. So with that, I will hand it over to Imran.
Thank you. . I know Imran was having some technical difficulties, so I cannot hear you, Imran, if you are speaking. Just bear with us for a moment. It looks like Imran will be logging off and coming back in. If you have any questions for Greg, now would be a great time. Actually, Chris, can you do your part?
Yep, I was going to suggest that. No problem.
Terrific. And we will come back to Imran.
All right, everybody. Chris Vignone, state and local tax. Excited to just share with you some thoughts today. I've kind of grouped our slides into there's a lot of tax law changes, right, that are going to impact this year. I've grouped them into 2 or 3 areas that I think we're going to be talking about a lot in 2025. So first of all, to start off and just jump right into it, same story. You go to the next slide. Same story as last year. Oh, I'm controlling the slide. Sorry about that. We got it. Same story as last year. Our rainy day funds at an all-time high. Okay, $160 billion. We had that at the beginning of last year. We're still there pretty much. The economy is humming, no matter what anybody says. We have gross domestic product continuing to grow, sales tax revenue, real estate values continuing to steadily grow. Of course, there's always holes in the market, but things are pretty good right now for the states. And part of what we're going to talk about in the next couple minutes is going to be how the states are going to be handling some of the excess funds that they have available. All right. So here's a summary of what happened in 2024 and then what we're looking at, what's going to happen in 2025. Sorry, I'm going to go to my glasses here. There we go. All right. So in 2024, we had some flat tax activity grow. When I say flat tax, I'm talking about state income tax rates. So several states got rid of their graduated rate and went to a flat tax rate. We're also seeing in 2024 and in 25 states adjusting the NOL limitation. This is really interesting because although states, like I said, do have this rainy day fund, there are states that are struggling, states like Illinois and California that have actually used these financial struggles in a way to reduce the NOL to be able to increase taxable income for corporations. We're seeing lower sales tax rates, more sales tax exemptions. Again, kind of a give and take with the state income. We're seeing significant activity. I'm going to talk about a little bit. It's really interesting. Significant activity around sin taxes, and states are still trying to figure out the digital economy. And these are some of the themes from 2024 and also carrying over into 2025 regarding state and local tax. I always like to throw something fun in here. May not necessarily apply to a lot of people, but we saw an uptick in sin taxes last year. One of the unique things we saw is California began to levy the nation's first separate excise tax of 11% on retail sales of firearms. So that was interesting. The Maryland state budget included an increase for tobacco products, including a significant increase from $3.75 to $5 a pack on tobacco. And that was a pretty significant increase on that. And then finally, we saw Colorado. They made changes and had significant increases that also applied to their tobacco taxes, increasing from 6.5 cents, may not sound like a lot, to 8 cents per cigarette. So that's almost a third increase in terms of the taxes in these states. Now, why are these states filling revenue gaps with these sin taxes? I think a lot of states are feeling pressure because there is this general theme out there that things are going pretty good. The economy is pretty good. They don't want to hit state income tax rates, whether it's on the corporate or individual rate. You'll see that. We had some decreases in rates in 2024. We expect some more in 2025 on the income tax side. There are specific gaps. Many times when they create these sin taxes, they create them specifically to fund specific programs. And so some of these are possibly that answer, right? Whether it's things in California, obviously we have a lot of things going on in California with budget issues, as well as states like Colorado and the larger states. So we suspect that we may see an increase in this when states have specific things that they want to target, specific holes they need to fix. They go to the sin taxes, they increase them, create new sin taxes that kind of fill some of those holes. They have less of a dramatic effect, right? And it only affects the people that are purchasing purchasing these items. So, but it's interesting. We saw a significant uptick in that last year. Okay. For our state and local income tax experts that are out there, for most of our CPAs, I always want to talk about throwback and throw out rules. Throwback rules, not as common these days. We're seeing the elimination of the throwback rule, also the elimination of property from the 3-factor formula going to a 1-factor formula. We had some changes last year. Maryland proposed a budget for the fiscal 2025 that includes the adoption of throwback rule. This is a little bit different because we're actually seeing a lot of states get rid of the throwback rule. So although this proposal included other items, it does expect significant challenges. So the theme of 2024 and 2023 was actually the elimination of a lot of the throwback rules. And that's interesting that Maryland is putting that in there. Arkansas began the phase out. This is more of what we're seeing of the throwback rule in 2024. And there'll be a complete elimination by 2030. I still think there's 12 to 15 states that have a throw-out rule, basically a throwback rule. For those of you that don't know, for state tax apportionment, for state apportionment purposes of your sales factor, you have the numerator and denominator. And so basically the throwback rule takes sales from states that you didn't pay income tax to and file returns and throws it back into the numerator in your home state. And the throw out rule takes those sales and takes it out of the denominator, so you don't have any impact. So that's general concept that we deal with in state income tax all the time. Bear with me here. Okay, always like to do a state conformity update, especially as everyone's preparing to do their 2025 returns. Greg mentioned this. Please remember, not every state conforms to federal depreciation rules, 174 capitalization rules, as well as many other items. So as you're doing tax planning for your clients that have significant state income tax liabilities, if you think you're going to bring income into because of 174, you may not within the state, and vice versa. If you think you're getting that bonus depreciation for that property, make sure when you're planning on the state side, it's a property that does conform. So here's a few updates. We always get an update from Florida. They always conform to it. They did again in 2024. We expect it to happen again. So for the following year, 2024, Florida is conforming to federal state tax rules. Georgia governor signed a bill updating Georgia's conformity as well. Okay, now and basically the term Internal Revenue Code is defined as the code as of a certain date. Again, Georgia conforming on all Internal Revenue Code statutes. And Maine Governor Janet Mills signed a law in document 2022 updating the state's conformity to the IRC for tax years beginning on or after January 1st, 2023. Again, Maine conforms to the IRC as amended in the effect of December 31st, 2023. So again, effective for 2024 tax years. And then finally, Oregon, updating the state's conformity to the IRC for beginning on or after January 1st, 2024. They do conform to the IRC amended as of December 31st, 2023. Many states have to actually come out and pass another bill or another law because, as you're aware, the federal law is changing, as especially in depreciation for bonus depreciation. So depending on the state, sometimes they're actually required to come out and pass another bill to conform to changes that happened on the federal side, simply because a change in a date, like 174 being being capitalized, the change in that, and the depreciation rule. Of course, we have big states like New York, right? New York does not conform to bonus depreciation rules, and that's really what you just need to be aware of, the states that aren't conforming. Always something good for a CPA to know when they're going into a conversation with clients. So let's talk about some significant updates in 2024 going into 2025. First of all, really interesting, any CPAs here in Massachusetts or anyone that has a significant Massachusetts tax liability, sales tax, payroll taxes, income tax, Massachusetts is rolling out a amnesty program. These are far and few between. So, we see maybe one or two a year. Sometimes we don't see one in an entire year. Massachusetts is a big state, and they're going to roll this program out. We believe it's going to be approximately a 60-day period ending before June 30th, 2025. So plenty of time, But if you have any clients with big Massachusetts liabilities, here's a great way to limit some of those costs. Definitely penalties and, let's see, possibly interest with a look back period in there. All right, Minnesota. This is 86-272 issue. I always like to bring this up. As many of you are aware, hopefully, when you're filing a tax return, you're filing your federal return for a company that sells tangible personal property. You only have to file in states where that company has physical presence outside of the scope of 86-272. 86-272 says companies that sell TPP cannot be taxed on an income tax basis from other states unless there's certain activities. So we're always interested what those certain activities are when states come out with different rules. So here's Minnesota coming out. Supreme Court determined that market research activities performed by a Wisconsin company sales team in Minnesota were not protected by 86-272. So you could have a salesperson in the state. Generally, salespeople are taking orders in that state. Those orders generally do not basically breach 86-272. But apparently Minnesota says if you go beyond taking orders and you have market research activities done in the state by those sales team, that could breach 86-272, requiring you to file a state income tax return there. So always something interesting to take a look at there. Another theme I mentioned for 2024 and 2025 is the elimination or deferral of net operating loss deductions. Okay, so we have a House bill in June signed limiting the utilization of NOL deductions to $500,000 in tax starting in 2024. All right, so again, clients with big NOLs on the federal side, do some planning this year. You may be limited in Illinois from that. That may create some significant state tax deductions. So do a little planning there. Same theme, net operating loss deductions being reduced. We have a bill in California last year, and the bill has suspended the NOL deduction for tax years beginning on or after January 24th. All right, the suspension applies to taxpayers with a net business income of $1 million or more. All right, so you could have high-tech business that created a ton of NOLs. They won't be able to utilize those. They'll be suspended for 2024, possibly creating a federal loss, but a state income tax liability. All right. Another theme I talked to you about the last couple of years was going to a single sales factor. Here we go. Tennessee now has gotten rid of the property base from the Tennessee franchise tax. All right, so all we have is a sales factor now in Tennessee on the Tennessee franchise tax. Again, another theme that we're seeing, getting rid of throwback, going to a single sales factor, and having really a clear line in the sand. One of my favorite states, I live in New York, spend a lot of time in New Jersey. One of my favorite states from always being challenging on the tax side. Last year in 2023-24, New Jersey came out with a bright line test for economic nexus for income tax of $100,000. And this year they decided to add a 2.5% corporate surtax on their already pretty high rate of 9% on any type of taxable income over $10 million. So if you have companies with large amount of income allocated to New Jersey, again, planning purposes, when you're doing your estimated taxes, in addition to the high tax rate, you now have this 2.5% corporate income tax on top of it, a surcharge. So again, those of you make notes about New Jersey, follow up with that. Okay, on the other side of all the bad news is 14 states have lowered individual income tax rates for 2024, continuing what some are calling tax cut fever. Listen, the states want to be able to tell people, right, that they're using this rainy day fund to reduce taxes. So a lot of this is really about, how they want to look to the public and, whether it's political reasons or whatever it is. And here's a bunch of states that push that agenda forward in 2024. Listen, it's good for us. But like I said, there are other ways that the states are looking to recapture revenue or be able to fill specific revenue targets like we talked about when it comes to the sin taxes. All right, sales tax update. A few updates just for everybody. Things I thought would be important. So Virginia has vetoed a bill that will allow all counties and cities in Virginia to impose an additional sales tax. This is really interesting. As you guys know, a lot of states have both a state and local sales tax. Occasionally we see a state try to impose or a state stop a locality from applying a sales tax. So This was expected to generate nearly $1.5 billion in sales tax revenue. So this bill would have authorized all counties and cities in Virginia to do that, but looks like right now it's going to be vetoed. Oklahoma governor signed a bill allowing counties to levy a 1% sales tax on most transactions subject to the state sales tax. Okay, so we have Virginia denying the governor an additional sales tax on the locality, but Oklahoma giving the thumbs up to counties. 2 states have enacted retail delivery fees. No, this is really interesting. You know, Colorado a few years ago had a retail delivery fee, and now it looks like Minnesota has a retail delivery fee that's going to kick in now in 2024. I didn't feel like the Colorado delivery fee was really effective. It was kind of hard to track. I mean, we helped our clients estimate the delivery fee on the sales tax returns. These fees are generally based on the sales tax returns. I'm a little surprised to see Minnesota doing it. I really don't think the Colorado one was received very well by businesses. But anyway, regardless, Minnesota has passed that. And it looks like that's going to go forward. The higher fee kicks in July 1st, 2024, unless opponents to the fee repeal it, which I haven't heard it's been repealed yet. I think that's still going to move forward in Minnesota. Indiana and Wyoming have eliminated the economic nexus transaction thresholds. For anyone that spends a lot of time in sales tax, you realize that we have a $100,000 threshold on the sales side, but we have this 200 transaction count. The 200 transaction count is always difficult to manage because a lot of companies hit that. So what we've seen over the last couple of years is companies going away from that 200 transaction count, eliminating it, and just have a dollar threshold. Thank you very much, Wyoming and Indiana. Kansas state sales tax rate and food ingredients has dropped from 6.5% to 2%. Again, this is going to have a real broad effect and affect everybody, especially in lower income. And so that's why the states, when they have that extra money, these are the types of laws that they're applying to that. Groceries will be exempt in Oklahoma in August 2024. Thank you. Maybe help out with inflation a little bit. And some states are looking to reduce or eliminate pink taxes. This is also often a term I'm not a big fan of, but whatever, on menstrual and diapers. But we're looking to apply lower tax rates in a couple of states on the pink taxes. All right, let's roll out that polling question. Which statement is true? All right, rainy day funds are at an all-time high. Many states are simplifying state apportionment rules by going to a single sales factor. States continue to simplify sales tax thresholds by eliminating the transaction count, or all above. So, like I said, listen, the government will always try to find ways to raise more revenue. But without a doubt, we've seen a theme, 23, 24, possibly going into 25. What I am hearing is that the states are being a little more cautious, looking at the impact of the Trump administration and the changes that they're already doing. Obviously, many of you heard the other day, just yesterday, about some of the programs where funding's been halted. A lot of that funding goes to states, and it'll be interesting to see how that may affect certain types of state programs and if states will tighten up in 2025. If nothing else, we expect a very volatile year in 2025 as the states try to react to all the federal, not even legislation, right? These are executive orders to try to figure out how these executive orders are going to affect state revenue. All right. Are we good on that, Ann?
Yep.
We're good.
All right. The answer was everything, right? It was D, all of the above. Those are all the items that we talked about that are themes for 2024. And going to carry on to 2025. And I think that's it.
All right, perfect. Thank you, Chris. And I apologize for the technical difficulties, but I promise you are not missing out on much here. Let me go down to the energy slide and go through this. We all have about 15 minutes, so that should be enough time to cover some of the energy presentation slides. All right. So for the next 15 minutes, here's what we would be going over. A quick recap of Section 179D, tax deduction, Section 45L tax credits, We'll quickly go over the investment and production tax credits as well as some of the changes in the rules from the Inflation Reduction Act. Now, this is something that most of you have probably heard of. It's a Section 179D tax deduction that applies to commercial and high-rise residential properties. Tax-paying entities can avail the tax deduction as long as it's a new construction project or major renovations were done to the project itself. The other vertical under 179D is if a project is a government-owned entity or starting from 2023, due to the Inflation Reduction Act, if it's a non-for-profit, since those firms cannot take the 179D deduction, that deduction can be allocated to the design firm. Architects, engineering firms, design build contractors are all eligible for the 179D deduction. Now, what is the 179D deduction amount? Until the end of 2022, so this is all pre-Inflation Reduction Act, that deduction used to be up to $1.80 per square foot. When the IRA got signed up, that deduction went up from $1.80 to anywhere between $2.50 to $5 per square foot. Now, it does require certain prevailing wage and apprenticeship requirements to be met, or if the construction began prior to the 29th of January 2023, you can go after the $2.50 to $5 per square foot deduction without having to meet the prevailing wage and the apprenticeship requirements. Now, in a scenario where the construction began after January 2023, the project does not meet the prevailing wage and the apprenticeship requirements, that deduction is limited to 50 cents to $1 per square foot. So you're looking at a 5 times multiplier depending on PWA or beginning of construction exemption. In any case, you do have a tax deduction irrespective of which scenario you fall under. Now, this is just a one-page summary of what we just discussed. It explains the differences in qualifying criteria as well as the deduction range pre-IRA, which is pre-2023, and then deduction starting from 2023 moving forward. A quick case study of a project post-Inflation Reduction Act, about 110,000 square foot. Again, one of the reasons for having this example is, if you notice, this doesn't get the 50% maximum savings and therefore a $5 per square foot deduction. That savings is around 42%. However, it does still get about $4.57 and therefore about $500,000 in tax deduction going to the design firm since it's a public school. Here's generally what a 179D project timeline or process looks like. Looking at the architectural engineering plans, doing a quick review, providing an estimate of benefit summary. A 179D study does require a professional engineer licensed in that jurisdiction to sign off on the report. So energy calculations, site inspections, and the final certification signed by a PE would be a requirement to get certified. For design firms, the only additional step is to get a signed allocation letter from the government or the non-for-profit entity. Now, a question comes up of, can multiple design firms go after this? Absolutely. As long as that deduction is split among 2 firms or more than 2 firms, and that's mentioned on the allocation letters, that 179D deduction can be taken by multiple design firms. 45L is basically a residential counterpart to Section 179D. 179D applies for all commercial and all residential that are 4 stories or higher. 45L basically handles all residential properties that are 3 stories or less, at least until the end of 2022. So, pre-Inflation Reduction Act, a residential builder or developer who has basis on the project, whose ownership throughout the construction process, and then when the construction gets done, the developer ends up leasing or selling these units individually. That client is able to take the 45L tax credit. Pre-IRA, that tax credit used to be $2,000 for every dwelling unit. Starting from 2023, there are quite a few changes to 45L. One of the major ones is the way you qualify a 45L project requires either Energy Star certification or the Zero Energy Ready Home certification. Depending on the certification that the builder gets, that tax credit could vary. It's $2,500 for Energy Star, $5,000 for the Zero Energy Ready Home certification. And this is absolutely true for single family builders, duplex, or townhome builders. When it comes to multifamily projects, there is a prevailing wage requirement. If a builder complies with prevailing wages or Davis-Bacon wages, they will be getting the $2,500 or the $5,000 depending on the certification. If not, the tax credit is limited to $500 for Energy Star or $1,000 for the Zero Energy certification. So there's a 5 times multiplier for multifamily builders depending on PWA compliance. Starting from 2023, one of the positives that came out of the IRA was there's no limitation anymore on the number of stories. Simply put, a high-rise residential property can be eligible for the 45L tax credit. And if you remember, that same property is also eligible for 179D. So a residential property that's 4 stories or higher can take both the 179D tax deduction and the 45L tax credit. Here's a quick case study. Again, a residential builder multifamily project, 144 units. This is one where we were able to help out the client with both Energy Star and the Zero Energy Ready Home certification. And therefore, that's about $5,000 per unit. Now, some may ask, this is a multifamily project. Aren't they required to pay prevailing wages? And that was exactly the case here. Thankfully, this was affordable housing, low-income housing tax credit project, and they were mandated by the housing authority to pay prevailing wages. So those facts and circumstances really helped out with maximizing the tax credit that they were able to avail. So moving on from 179D and 45L, let's talk a little bit about the investment and production tax credits. And my goal is not to go through every ITC and PTC that's listed here, but to at least familiarize you with all of these incentives that you have for your clients if they are dealing with certain renewable energy systems or with carbon capture systems or with clean hydrogen or clean fuel production. The most common of which is the Section 48 tax credit. A lot of you probably remember this through the solar or the geothermal projects that we've come across in the last few years. That's Section 48 tax credit. And that's basically, I'm going to come back to this one, but that's basically a 30% tax on the cost of the eligible system. So if $1 million worth of solar or geothermal or combined heat and power is installed, that project is probably eligible for about $300,000 in tax credits at a minimum. Now, there are certain bonus tax credits as well. If the project complies with domestic content, which basically requires a portion of the eligible system to be manufactured in the US, that's an additional 10% tax credit. So 30 could be about 40%. If the project is located in what's called an energy community, a census tract, that's an additional 10%. So that could be another 50% of the overall tax credit. So there's multiple steps that we'll have to look into to determine, are we going after the base tax credit, or is there a chance to maximize the tax credit by applying for domestic content or falling under the energy community requirements? Now, the eligible systems, and hopefully this is the takeaway from the ITC tax credits, and there's a lot to discuss. It's probably unfair to have all of these within a 20-minute time frame. But if you run into solar, geothermal, fuel cells, biofuels or biogas, combined heat and power projects, do know that there is a tax credit that is available, and under the Inflation Reduction Act that has been extended to 2032. So there's a little bit of stability in getting these tax credits. Now, I'll take a step back here. The Inflation Reduction Act, apart from extending these tax incentives, also brought in a way to monetize some of the tax credits. From taxpayers, there is the transferability option wherein you're able to sell the tax credit in a marketplace and get monetized. This is the first time that's happened where non-for-profits or government entities are finally able to actually monetize some of the credits as well. A good example is a school district or a church that's installed solar panels is able to actually go through what's called an elective pay or a direct pay option, pre-file their tax registration numbers, and actually get a refund back or a cash back from the federal government. So this is, again, one of those things where non-for-profits and state local government entities are finally able to monetize some of the credits. Now, I do want to cover the polling questions so everyone gets that CPE. One last note about prevailing wage and apprenticeship requirements. Now, these are requirements that have to be met to get the additional tax incentive. Prevailing wage is basically Davis-Bacon. Contractors and subcontractors have to pay prevailing wages as determined by the Department of Labor for a specific zip code or for a specific county. On the flip side, apprenticeship requirements basically say 15% of the total labor hours have to be performed by certified apprentices. Now, there are good faith exemptions. There are beginning of construction exemption in which if the construction of a project began prior to the 29th of January 2023, none of the prevailing wage or the apprenticeship requirements have to be met in order to get the higher tax credit or tax deduction range. Two ways to determine that. The easy way is there's a physical work test. You've got pay applications. You already know vertical construction began prior to the 29th of January 2023. Foundation was already poured. That's an easy one. Go after the higher tax incentive. The other way to look at it is the 5% safe harbor rule. If 5% of the costs were incurred prior to the 29th of January date, 2023, you are eligible for the higher tax incentives. Right, let's go to the polling question. Yeah, starting from 2023, the following entities are eligible for the elective pay option: public school, tax-exempt building of worship, non-for-profit hospital, all of the above.
Imran, there's a question for you in the Q&A. Would you like me to read it?
Nope, I got that.
Okay.
So there's a question about how a 179D deduction ties into a cost-seg study. Great question, because a lot of our studies include both cost-seg and 179D together. 179D deals with real property, the HVAC system, the building envelope, your wall, your windows, your roof, or your interior lighting. In most cases, all of these are either 39 or 27 and a half year property, and therefore the 179D deduction reduces the 39 and the 27 and a half year basis by the deduction amount. So this is almost like a one-time bonus depreciation that you're getting on a cost-seg study.
We need a few more responses. Looks like all the above is winning, and I think we can move forward.
Yeah, that should be it. Yeah. Thank you all for joining.
Thank you. If you're eligible for CPE, you will receive your certificates in the next 3 business days. Thank you.